I think you've got a government debt market crisis and a government crisis and a currency crisis, not just dollar versus the euro, for example, the dollar index. I'm talking about the overall valuation of the money units, where the public will become more and more aware that, you know what, I'm paying more for gasoline because it's not because gasoline's going up, it's because the dollar is going down in real spending power. You know, if you go back historically and measure things by M2, they almost doubles every decade. Well, I mean, when I was a kid, a loaf of bread was 20 cents. We don't have a wheat drought. You got a degradation in the money unit, and it's ongoing. And sometimes, because when the central banks panic, that degradation in the money unit increases in terms of percentages. And I think we're at that point now where when you break these stock market bubbles, specifically the US bubble in particular, that's going to cause massive central bank panic, which is going to do nothing but more exacerbate this underlying fiat currency degradation and hence commodity price inflation. And again, it's really not them going up, it's the money unit collapsing, and it's affecting people. And a lot of people don't see it that way. They think, gold's going up. In fact, it's not. It's the dollar in real value collapsing, or the euro and the yen. And when that gets out of hand and there's a public perception that that's really what's going on here, then you have an upending of a lot of institutions. I've been saying for over a year now, there'll be a point in the next couple of years you don't have a Federal Reserve. I'll make that bet. It is intellectually dismissed, and there's even a lot of academicians who are favorable to the Fed, have been for decades, that are doubting its policy directions for the last couple of years, especially too high, too long, that kind of thing. And where there's enough doubt, and when you go back and look at the boom-bust cycles of the stock market, they correlate very well, lag to the boom-bust cycles in monetary policy. You boom the money supply up, and the stock market a year or two later takes off. And then suddenly, if they start to level it out, or they start to raise rates, then the stock market, at lag to that, goes down. But this time it's different because the bubble is so much bigger, especially in the U.S. and also Japan and India. But focus on the U.S. If it busts, and we claim it's the biggest bubble in U.S. history in dimensionality and duration, that when it breaks, the unwinding of so many errors and policy errors as well will come to the fore. The Mises Institute, which is one of the largest, it's a libertarian think tank, they had a full-page ad in the Wall Street Journal about a month or two ago that said, abolish the Fed or end the Fed. There's a whole page. Looked like an editorial, but it was an ad, but it was an intellectual argument to abolish the Fed. And there's a lot of people who are, if you run into this crisis that we're trying to define here, the stock market implosion and ultimately government debt market crisis, people are going to look back and say, the Fed's booms and busts in monetary policy create nothing but booms and busts in the economy. They're not a cure, they're a cause. Hence, what do we need them for? We didn't always have them, only been around 100 years, not been around 1,000. And maybe we need to go back to real money. Thoughts come up in other countries as well, by the way. There are intellectuals in Europe and elsewhere that have said, we've made errors here in the last decades, non-backed currencies. And I think once you have a crisis, then suddenly that process, that thinking process will occur, and policy changes will occur where things are abolished, and probably quickly. So it's going to be an interesting coming year. I think a lot of this is going to happen in the next year.
Michael Oliver dives deep into the broader implications of the government debt crisis and currency devaluation, offering insight into how these systemic issues can transform the landscape for gold and silver investments. For many, the fluctuating prices at the gas station or grocery store are the most visible signs of economic stress. Yet, as Oliver points out, this is only one layer. The real issue lies in the devaluation of the dollar and other fiat currencies, a subtle yet profound shift eroding the purchasing power of money, which has occurred over decades but is now accelerating. Oliver brings to light a reality that most overlook. Prices aren't necessarily rising because goods are more valuable. They're increasing because the dollar is worth less in real terms. Historically, the U.S. money supply, M2, has nearly doubled every decade. That's a staggering rate when you think about how this gradual devaluation affects everyday life. For instance, Oliver reminisces about when a loaf of bread cost a mere 20 cents. Today, it's not due to a shortage of wheat or grain, but largely because of a degraded dollar. This same degradation is impacting essential commodities like gold and silver. Although people often view these metals as going up, the reality is they're retaining their value while the dollar declines. The concept becomes even more alarming when one considers the central bank's role in perpetuating this cycle. According to Oliver, when markets enter a crisis, central banks often panic, flooding the economy with liquidity. This approach only hastens the decline of currency value, causing what Oliver calls commodity price inflation. People see it as rising prices, but it's actually a reflection of the decreasing worth of fiat currency. This looming crisis is not just about one currency against another, like the dollar versus the euro. Instead, it's about a global devaluation of money units across the board, where people start realizing their money buys less and less. What happens when public perception shifts to see the dollar's true loss in value? Oliver predicts that this realization could lead to a dismantling of major institutions, including the Federal Reserve. He's not alone in this belief. The Mises Institute, a libertarian think tank, even ran a full-page ad in the Wall Street Journal calling for the Fed's abolition, asserting that the Fed's cycle of booms and busts in monetary policy creates a corresponding cycle in the economy. For these critics, the Fed is not the cure, but the cause of economic instability, driving calls to reconsider the role of real money like gold and silver. Moreover, Oliver emphasizes that the current U.S. stock market bubble is the largest in history, both in size and duration. If and when this bubble bursts, the fallout could be immense, unearthing decades of policy errors. The Fed's policies, designed to keep markets artificially buoyant, have created a situation where the consequences of a downturn are amplified. When this bubble breaks, as Oliver suspects it will not just be a market event, but a systemic crisis that questions the very role of fiat currency and, by extension, institutions like the Federal Reserve. Transitioning to silver, Oliver provides a compelling case for its undervaluation relative to gold. He delves into the gold-silver ratio, which measures the price of silver relative to gold. For nearly 21 out of the past 50 years, silver has reached at least 2% of the price of gold. To put this into perspective, silver has historically risen to around 2 to 3% of gold's value, especially during peak times, such as the 1980 bull market when it hit $50 per ounce. At that time, silver was a remarkable 65% of gold's price. Oliver's technical analysis of the gold-silver spread offers another dimension to this outlook. By measuring the spread's weekly or daily movements, he's able to identify potential breakout points. Once silver breaches the 1.3% threshold, a significant technical signal would trigger, pushing silver to outperform gold dramatically. He compares this to the 1979 to 1980 bull market, where a similar breakout in the spread led to both metals surging, with silver leading the charge. The same pattern emerged in 2010, just before silver hit $50 again. In essence, Oliver sees silver as a ticking time bomb. When it finally breaks out, it could bypass its previous high of $50 per ounce and continue rising with little resistance. Investors who have watched silver stagnate for years may be in for a surprise when it finally gushes past its old highs. This potential for explosive movement is not only based on historical precedent, but is also grounded in the current economic and monetary conditions.
When we measure the spread of silver versus gold, it's a ratio. We divide the price of silver into gold, and so we get a percent. So silver, if you go back 50 years and plot a bar graph chart, which we did in the weekend report, showing the peak silver to gold spread reading that year, you'll see that in that 50-year period, 21 of those years reached at least 2% level, where silver was 2% of the price of gold. In the 1980 bull market, when silver reached 50, that first time it ever did, it was up to 6.5% of the price of gold. And then it fell back down. And then in the 2011 peak, when silver again reached 50, gold was 1900, silver reached 3+% the price of gold. Silver right now is 1.189% or 1.19%, let's say. The price of gold is very cheap historically in relation to the price of gold. But when you measure the spread technically, week by week or even day by day, and create a momentum chart of it, you can even see it on the spread chart. You get up above 1.3% by much, and you're going to blow a cork, meaning silver is going to outperform gold vastly. It's going to unleash. technically. And again, we're just below 1.2% right now. And I think there's enough things just above 1.2 to drive you up to that 1.3+% level and trigger this bigger stuff. But if silver went to 2% of the price of gold, again, it's been at 2% 21 of the past 50 years. So it's hardly an excessive thing. And gold, we're even, just 3,000. Okay, 2% of 3,000, you do the math, okay? An all-time new high, $60. Okay. And I don't think gold's going to 3,000. A lot of people have that as a working target, some major firms. I think gold's going, the next stopping point will be 3,200. And if silver happened to be 2% then, and the spread broke out, and by the way, when that spread breaks out, it is also a signal that the net price action of both metals is about to go vertical. It happened in 1979 to 80 when the spread exploded. Silver exploded. Gold exploded too, but silver led. And it happened in 2010, latter half of 2010, prior to the rush in silver by April of 2011, where it reached $50 again. The spread broke out. And sure enough, silver price unleashed at the same time, net-wise and versus gold. And we have the same pending situation right now, where if we break that spread out, you don't even have to look at a silver chart or a gold chart anymore. Just assume they're both going to go vertical. Only this time silver is going to vastly outpace gold. And it's got so much room to do so, to even get back to, quote, what you could call normal levels, that if gold were to go to, for instance, our next level that we think there might be a stumble or a pause is 3,200. Well, if silver reached 2%, we'd be $66. So I think what we're seeing right now in silver with this congestive action in the low 30s is when you break out of this stuff, those two peaks at 50, historical low peaks, 1980, 2011, they're going out fast. Then likely silver's going to gush past those highs before it even pauses. And that'll, of course, wake up the world.
Michael Oliver elaborates on why silver specifically is positioned to outperform gold in the coming years. This is not merely a function of market cycles, but is intricately tied to the fundamental flaws within the global monetary system. He points out that silver's current price relative to gold is at historically low levels, a phenomenon that's unsustainable if one considers silver's intrinsic value and practical applications. While gold has traditionally been a store of wealth, silver's role in industrial applications is growing exponentially, adding a layer of demand that gold simply doesn't face. To drive this point home, Oliver revisits the historical spread between silver and gold, noting that every time the spread tightens to certain levels, like the 1.3% mark he mentioned earlier, silver experiences a massive rally. This rally isn't just speculative, but is rooted in both technical momentum and fundamental demand. The breakout threshold for silver would set off a technical signal, attracting institutional and retail investors alike. This influx would drive prices higher at an accelerated rate, pushing silver well beyond previous highs. An important factor supporting this silver rally is its increasing role in technology and green energy. Silver's unique properties make it invaluable for applications like solar panels and electronics, sectors that are rapidly expanding. As countries worldwide commit to renewable energy and technology advancements, demand for silver will only increase. Oliver stresses that while the public often views silver through the same lens as gold, its industrial applications make it far more dynamic in today's economy. At the same time, Oliver sees a looming crisis in government debt markets that will amplify silver's appeal. In the U.S., the national debt is at unprecedented levels, and the Federal Reserve's options to address this are limited. Should the Fed continue with rate hikes, it risks a downturn that would tank the stock market and cause widespread panic. If it opts for rate cuts, inflation would rise, eroding the value of the dollar even further. Oliver argues that either scenario is favorable for precious metals, particularly silver, as a hedge against this uncertainty. This perspective on silver is amplified by the public's shifting perception of fiat currency. Oliver argues that we're approaching a point where the average person will realize that rising prices aren't about increased costs, but about the dollar's diminished buying power. For instance, when people see gasoline prices increase, they're inclined to blame oil companies or supply shortages. However, Oliver suggests that these price increases reflect the devaluation of the dollar itself. Once this awareness spreads, demand for real assets like gold and silver will soar as people seek stable stores of value outside the traditional banking system. This brings us back to the potential dismantling of the Federal Reserve, a scenario that Oliver considers increasingly likely. Public dissatisfaction with the Fed has grown as people see the direct impact of its policies on their cost of living. Oliver isn't alone in this belief. The Mises Institute, a libertarian think tank, even took out a full-page ad in the Wall Street Journal calling for the Fed's abolition. The Fed's policies have led to boom and bust cycles that erode public trust, pushing people to consider alternative forms of money. Silver in this scenario stands out as a compelling choice. Unlike gold, which serves mainly as a store of wealth, silver is both a monetary and industrial asset. This dual role gives it an edge in a diversified portfolio, especially as the global economy undergoes significant transformations. While the U.S. grapples with debt and inflation, emerging markets like India and China are accelerating their silver consumption, particularly for industrial applications. This global demand will only compound silver's price appreciation, making it an attractive investment for those looking to hedge against fiat currency devaluation. Oliver also references the structural deficiencies in fiat currency systems, particularly in how they rely on perpetual debt expansion. As governments continue to issue debt, they dilute the currency's value, creating an environment where real assets like silver become indispensable. He notes that fiat currencies are essentially units of trust, and as that trust erodes, people will look for assets that are not tied to government policies or central bank decisions. Silver, with its tangible value and broad applications, fits this need perfectly. In addition to individual investors, central banks are increasingly turning to precious metals to diversify their reserves. Countries like Russia and China have been steadily increasing their gold and silver holdings, signaling a shift away from the US dollar. This trend is accelerating as global tensions rise and countries seek to insulate themselves from US economic policies. For these nations, silver and gold represent independence from a financial system dominated by the dollar, which could lead to a significant revaluation of these metals. Lastly, Oliver forecasts a scenario where silver and gold prices move vertically as fiat currency systems falter. The gold-silver ratio will likely tighten, pushing silver's price higher relative to gold. For instance, if gold were to reach $3,200 per ounce, a modest 2% valuation for silver would put it at $64 per ounce, double its current price. This wouldn't be an anomaly. It would be a return to historical norms under extreme economic conditions. In summary, Michael Oliver's analysis offers a compelling case for silver as an essential investment in today's uncertain economic climate. From its undervaluation relative to gold to its rising industrial demand and role as a hedge against fiat currency, silver is uniquely positioned to outperform. As central banks, institutional investors, and individuals alike look for alternatives to devalued currency, silver's potential becomes clearer. Oliver's message is clear. In a world where fiat money loses value daily, real assets like silver offer stability and long-term growth potential.